How to optimize algorithmic trading for small accounts. Algorithmic trading has revolutionized the way individuals approach the financial markets. Traditionally reserved for institutional investors with deep pockets, algorithmic trading is now accessible to retail traders with even modest capital. However, optimizing algorithmic trading for small accounts requires a strategic approach to maximize returns while minimizing risks. Here are 3 key points to consider. Point 1. Start small, dream big. Allocate a reasonable portion of your capital to algorithmic trading. It's essential to begin with a conservative allocation of capital to algorithmic trading, especially when working with a small account. By starting small, you can test different strategies without risking a significant portion of your funds. Example 1. Suppose you have a $10,000 trading account. Allocating 10%, $1,000, to algorithmic trading allows you to explore various strategies while still maintaining a diversified portfolio. Example 2. Sarah, a retail trader with a $5,000 account, decides to allocate 20%, $1,000, to algorithmic trading. She diversifies her investments by allocating the remaining 80% to traditional stock investments. Starting small allows Sarah to experiment with different algorithmic strategies without risking her entire capital. Over time, as she gains confidence and sees positive results, she can consider increasing her allocation to algorithmic trading. Point 2. Focus on efficiency. Prioritize strategies with minimal capital requirements and transaction costs. Efficiency is paramount when trading with a small account. Opt for strategies that require minimal capital to execute effectively. For instance, consider a strategy based on low-priced stocks or forex pairs with low margin requirements. Additionally, prioritize strategies with minimal transaction costs, such as those that involve fewer trades or utilize commission-free trading platforms. By minimizing expenses, you can maximize the net returns on your trades. Example 1. Let's say you're exploring algorithmic trading strategies for your small account. You identify a trend-following strategy that trades low-priced stocks with high liquidity. This strategy requires minimal capital per trade and incurs low transaction costs due to the infrequent nature of trades. By focusing on efficiency, you can optimize your trading approach to yield higher returns relative to your account size. Example 2. John develops an algorithmic trading strategy that exploits intraday price movements in the forex market. His strategy focuses on major currency pairs with high liquidity, requiring minimal capital per trade. Furthermore, John uses a broker that offers commission-free trading, minimizing transaction costs. By prioritizing efficiency, John maximizes his returns while conserving capital for future opportunities. Point 3. Reinvest profits wisely. Gradually scale up your investments based on consistent, sustainable returns. As your algorithmic trading strategy begins to generate profits, resist the temptation to immediately scale up your investments. Instead, reinvest your profits wisely by gradually increasing your position sizes. This approach allows you to compound your gains while mitigating the risk of significant losses. Additionally, prioritize consistency and sustainability over rapid growth. Only scale up your investments when you've achieved a proven track record of success. Example 1. Suppose your algorithmic trading strategy generates a consistent monthly return of 5% on your initial investment. Instead of reinvesting all profits immediately, you decide to reinvest 50% of your gains each month while maintaining the remaining 50% in your trading account. This gradual approach to scaling up your investments allows you to compound your returns over time while minimizing the impact of potential losses. Example 2. Michael's algorithmic trading strategy generates a consistent weekly return of 2% on his $2,000 initial investment. Instead of withdrawing his profits, Michael decides to reinvest 50% of his gains each week while keeping the remaining 50% in his trading account. Over time, as his account grows, Michael gradually increases his position sizes, maintaining a disciplined approach to risk management. This disciplined reinvestment strategy allows Michael to compound his gains and steadily grow his account over the long term. Conclusion. In conclusion, optimizing algorithmic trading for small accounts requires a cautious yet strategic approach. By starting small, focusing on efficiency, and reinvesting profits wisely, Retail traders can harness the power of algorithmic trading to achieve their financial goals, regardless of the size of their accounts. Remember, success in algorithmic trading is not just about making big bets but about making smart and calculated decisions. Happy trading!